Hello and welcome to the lecture for part 2 of chapter 7. So I ended part 1 with talking about the allowance method, and I talked about how management would estimate what their allowance should be at the end of the year, or estimate what their bad debt expense or uncollectible expense or uncollectible account expense would be at the end of the year. So now we're going to talk about how we estimate that. And as with most things in life, there are easy ways that are not as good and there are harder ways that are better. So the first two methods that are shown here, percent of sales and percent of receivables, are the easy ways. So it's just a matter in either case of taking what our past experience has been, or if we're a brand new business, we might look at industry averages, and applying either a percentage of the credit sales we make to determine what our bad debt expense should be. For example, in the past, if approximately 5% of our sales we ended up not collecting on them, then this year we would take our credit sales multiplied by 5%. That would be our bad debt expense, and we would increase our allowance for doubtful accounts. Or we could do it based on the percentage of receivables. So of all the people that owe us money, how much are not going to pay? What was the past experience? Apply that percentage to how much people owe us now, and then book that entry. So those methods are perfectly acceptable. The math is fairly easy, but again, they don't really do the best job of matching the expense of uncollectible accounts with the sales in the period in which they're made. So a better method, in my view, is to do an analysis of an aging of receivables. So I'll talk about that in some detail. So the first step is we're going to determine for every invoice that's owed to us that is outstanding, so that has not been paid, what is the due date on that receivable. Then I can determine the number of days past due it is. Of course, that's something we can do in Excel. And then I'm going to rank them so that I place the amounts in an aged class category. So maybe the first category is invoices that are not past due yet. The due date hasn't come up yet. And then things that are past due 30 days, things that are past due up to 60 days, and so forth. So I'm going to come up with a total for each of those. So what's the total amount of invoices that are not due yet? What's the total amount that's between 1 and 30 days past due, and so forth. And then I'll take a percentage of each of those totals to come up with what my total estimated uncollectible receivables should be. And that's under the logic that the longer something is past due, the less likely it is that I'm going to collect it. Okay, if something's a year past due, chances are pretty good I won't collect it, so I'll have a very high percentage on that column. And the key thing here is when I come up with that amount, that's the amount I want my allowance to be. So I'll take a look at what my allowance is, what I want it to be, and I'll make an entry to get it there. So as an example, if I do this analysis and I say my allowance should be $25,000, and I look at what it is now, it's actually $10,000 right now in that allowance for doubtful accounts column, then I need to record $15,000 of uncollectible accounts expense and increase my allowance so it ends up at $25,000. So here's a picture of a typical kind of analysis here. So the first customer, Ashby and Company, they have a $1,500 balance and it's between 31 and 60 days past due. BT Bar has several balances that are outstanding. You see one of them is between 6 months and a year past due. You can use any increments for the columns that you want. It's just important that you take a consistent approach. And then you can see Brock Company, they have 4,700. It's not past due yet at all. So then they total all of those columns, and you can see this company applies 2% to things that are not past due because some of them are going to go bad probably. And then as it gets older and older, they have a higher and higher percentage. Now again, those percentages, that's not chiseled in stone. It's based on your past experience, and it just has to be that you've got some rational method for arriving at those percentages and that you're not manipulating them. So that gives us a total at the bottom there. So, and we add those up. So in this particular case, this company has receivables of $240,000, and they believe that this analysis tells them that they should have an allowance for doubtful accounts of $26,490. So they would then look at where they were at, and they would raise their allowance up to that amount and recognize an expense for that increment that they need to raise it by. So the next topic I want to talk about are notes receivable. So again, remember back in the first part of this lecture, I talked about notes receivable being a more formal kind of instrument or contract with a customer about debt. So a little bit about terminology. So the maker or issuer of the note is the person that's making the promise to pay. So if I'm borrowing money from you and you ask me to sign a promissory note, I'm the maker of the note. You are the payee. You're the person loaning me money. You're who's going to get paid back. So you're the payee. The face amount is the amount that's being borrowed. It's also called the principal. The issuance date is the date that we agree and sign the note. Okay. The due date is when it's going to come due, some point in the future, and it can be called due date or maturity date. And the term is the length of time between the issuance date and the due date. The interest rate that's shown on the note is the annual rate of interest. So interest is always shown as an annual rate. So when I borrow money for 90 days on March 16th, I need to determine the number of, I need to look at a calendar and count the days to determine when it's going to be due. So in this case here, it's due not 3 months later, which would be June 16th, it's due on June 14th. And I can use Excel to do that, or I could keep track of which months have 31 days and which have 30, and I could figure it out that way. So the interest on a note payable is calculated as follows. The interest amount is the face amount or principal times the interest rate times the term of the note over 360 days. If the term is indicated in days, then you would do a term over 360. If it's in months, then you could do term over 12 months. But the key thing is that denominator is for a whole year. We use 360 just to make it the math a little more simple. But that's based on the fact that the interest rate is an annual interest rate. So we need to multiply by the fraction of the year that's applicable. Okay. The maturity value is the face amount plus the interest to be paid. So as an example, let's say we have a note that's $10,000 and it's 6% and the term is 90 days. Then I would calculate the interest to be 10,000 times 0.06 times 90 over 360. The interest would be $150. That's pretty straightforward. Well, what if I loaned the money on, let's say I'm the one loaning the money. What if I loaned the money on December 1st? Well, now that 90 days is straddling a year end, okay? So standing on December 31st, that person that owes me money not only owes me the 10,000, but they owe me part of the interest. So I need to divide that 150 into those two periods. So if I lent the money on December 1st, I would recognize 30 days of interest that's owed to me. And then the following year, I would recognize the other 60 days. So it would look like this. I would have $50 of interest income. Oh, and I have an error there. I apologize. That should say $100 of interest income in the second period. So the two numbers add up to 150. I apologize for that. So I hope that helps you. This will be beneficial for doing the third assignment in Chapter 7. And as always, if you have any questions, please don't hesitate to reach out and send me an email. Thank you.